Welcome back, everyone. Please don't be shy. Anyone coming in, please come forward, fill out the room at the front. That would be great. Please come and have a seat. We are now into our final few sessions of day one of IFGS 2024. I hope you've also had a chance to explore other sessions downstairs in the Livery Hall and the West Crypt. And just in case any of you are here tomorrow, this time tomorrow afternoon, we will also be kicking off the long-awaited return of Pitch 360, which is the pitching competition for some of FinTech's most innovative, fast-growth startups. So if you're here tomorrow, do join us for that. That's at 3:15. But for now, we're moving on with our next session. We're going to be hearing about how the UK can continue to set the standard for FinTech brilliance in the next 10 years, maintaining its position as a world-leading FinTech ecosystem. And to welcome our panel for this discussion, please welcome Sharon Lewis, partner at Hogan Lovells, with her panel. Please welcome them to the stage.
Good afternoon. I'm Sharon Lewis. I'm a partner at Hogan Lovells, and I've had the honor and privilege of working with Innovate Finance since more or less its inception. It's been a journey for me, and a wonderful one at that. We live in a somber world, domestically and internationally, but that is not what this panel is about today. The panel today is really thinking about what the UK has done so fantastically well in nurturing and developing the fintechs. When I started this job with Innovate Finance in 2014, people used to say to me, Sharon, why are you doing that? Is it not pro bono? Well, no, it's not. Today, it's business as usual. And so on that, I'm going to pass to my panelists and ask them, what is so brilliant about the UK fintech market? Kaushalya.
Thank you, Sharon, and thank you, Innovate Finance, for inviting FinTech Growth Partners to be here. It's a pleasure. So just a bit of introduction for myself and also the firm FinTech Growth Partners. We are a fund that was established on the back of the Khalifa review that took place back in 2021. We are a private sector response to that funding gap, which exists in the current market, which is to the tune of about 2 billion. And then we are a growth stage response, as I mentioned, to invest into companies that are Series C and beyond. And in terms of my background, I worked at Square up until I joined the fund, and prior to that I spent at HSBC about roughly 11 years in various roles. And just, am I okay to go straight into the questions, or do you want to?
You will.
Okay, perfect. So in terms of this particular question, I've been reflecting on this alongside some of the partners and the team. And there are three things I think that comes to mind in terms of the leverages, why UK has been such a predominant player and a dominant player in the world scene when it comes to fintech. The first is actually innovation. The second is regulatory support, and third is access to capital. So if I take them in turn, through innovation, it goes without saying that the UK, and in particular London, has been in the world stage as a leading tech hub and fintech hub. And that's thanks to many of these companies, the likes of, for example, Monzo, Wise, and Revolut, Checkout.com, all of whom have actually produced some very interesting and innovative offerings and trumped majority of the other major markets, as I call it, mature markets, including the US, when it comes to banking infrastructure, payments, as well as digital banking. And they continue to sort of ride the wave. And then I think one of the statistics that I saw also is that just in last year alone, there were 4 unicorns that were produced in the UK market, 2 of which were actually in the AI scene. So again, that shows a trajectory in terms of how the UK market is leading the wave in some of these innovation. The second aspect of it is the regulatory support. And then back in 2016, all of us know that the regulatory sandbox was established, and that has actually been a great success story where it's been mimicked and replicated in over sort of 50-odd jurisdictions. Similarly, we also saw the open banking, the CMA 9 order that again led itself to great initiatives on the back of that, opening the market to competition. That again has been replicated in very many markets, including about 50 to 60 jurisdictions worldwide in varying degrees of successes, some of which have actually done even better than the UK thanks to our lessons learned from that program. And the third part of it, I would say, is, most definitely, as I said, is access to capital. And obviously, the companies go through different stages. So the first stage is obviously founding a company, and for that, you need the regulatory support and innovation, fundamental to that. The second stage is as it goes through scaling, funding becomes a critical part of that. And again, when you look at the Innovate Finance statistics that have been posted, UK actually has attracted about 10% of the global allocation when it comes to funding, and represents sort of it's only one behind essentially the US market, so it's leading the way in that front. So second in that regard. And there are about 3,000 companies, FinTech companies, in the UK alone, of which when we look at the growth stage, there's about 700 to 750 of those here in the market. So again, it's a testament to how much capital we are able to attract thanks to the innovation efforts and the regulatory support that we have been able to garner.
Thank you.
I'll pass on.
Mark, one of the objectives of the Clifford Review was that we wanted firms not just to start up, but to scale up and become global leaders. How do you see us in terms of achieving that?
Well, I think what I'd say, Sharon, and I chair Pay.UK, which runs faster payments and backs. So companies like Monzo and Wise use our platforms. And I think that's, for me, is the key, that actually we've seen a series of very clear policy initiatives by government and regulators that have created the right climate for innovation. And as we move forward, we need to make sure that climate remains robust, that actually it needs to be predictable, that people need to know the direction of travel. So that's why I think something like the Garner Review, which really helped set out the argument for a very clear direction of payments, was a really strong intervention, which the government are responding to through the National Payments Vision. Because actually, if we're to move to the next stage of innovation, we need world-leading payment systems. They need to be ISO 20022 compliant. Firms need to continue to have open and fair access to them. So it's about trying to make sure that that policy agenda remains really focused on creating the right conditions, not necessarily picking individual winners, but how do you create the right climate for growth. I think we've been very successful in the UK in doing so. I think we'll continue to be successful in the future.
And you've been very focused, I think, Mark, on bringing in talent to the UK, to focus on that. Do you want to comment on that?
Yes, so one of the other things I do, I chair the Financial Services Skills Commission, and we're an industry body, partly sponsored by City of London Corporation, William. And actually, I heard an earlier session about AI, and one of the comments there was about the need for people with the right skills to be here. And it's about reskilling and upskilling. There's a huge number of high-skilled roles will be created in the UK. And I think if we are, as an industry, focused on that upskilling and reskilling, that will again create the right people that we need, the right skills and experience to exploit new technology, to think about how you harness AI to improve better customer outcomes. So there's a real opportunity, I think, around skills, around the right environment to continue success in the UK.
Thank you. William.
Sharon.
I'm going to move the conversation on a little bit.
I'm definitely going to have to say something about why we're so good here in the UK.
You go then. Go.
So, totally agree with what everyone said. And those who don't know, I was Lord Mayor 2019, 2021. I've been on the board of Innovate Finance. 10 years ago, when we first started, I was just reminiscing that it was either 10 years ago or 9 years ago, the Guildhall was full. And Nikolai from Revolut was telling everyone about Revolut, and it was just fascinating watching everyone in the room downloading the Revolut app. And this was 9 years ago, anyway. But following on the talent bit, talent is one of the great things that we have here in the City of London. And apart from the fact, and everyone who knows me, I'm incredibly upbeat, this is the greatest city in the world. It is the best place to work. Yes, it's a little too expensive, but we attract all this incredible talent. And when I was asked as Lord Mayor about Brexit, I used to say, as long as the talent, global talent, comes to London, then we're going to be okay. And I think that's proved absolutely right. And just as I'm hoping to chair the Barbican Arts Centre, we have the best cultural offering, better than New York and any other city in the world. So everyone wants to come and live in London, and that's a great thing.
I think that's definitely true. But I think we do have things to learn from the US.
Oh, definitely. Even though I'm not one of those believers, and I've heard ministers say it, no offense, Mark, I'm sure when you were in government you never said it, but, you know, we've got to be number one like NASDAQ. The reality is we're never going to be number one like NASDAQ in the world, because NASDAQ is enormous and unique. But we can learn a lot around the scale-up in America, which we're trying to do, and we all, obviously the big topic is about listings at the moment, and you know, how we can make that better for a lot of our companies, rather than going to list in the States. But I think we can learn about how we can scale up a lot of these companies. The good news is the companies are here, but now we need them to stay here. But it's no surprise that a lot of the big private equity, US, American private equity firms have offices here because they see the talent and some very exciting businesses here. But we can definitely learn a lot from the States.
Yeah, and you know, it does go in waves. I mean,
Yes.
you know, I've been here a little while, and you know, there was a time where you'll see international companies running to list in the US, and then post Sarbanes-Oxley running back, and you can see on subjects, for example, like ESG disclosure and the like, that they may come running back sooner than we think. And I think that, you know, thinking about that and how one attracts is a really important part of what we can do. But you know, thinking about that, what is it in your mind that could be done more to bring back and to actually create this opportunity for scale up? Mark, do you want to talk on that?
So I think it's trying to make sure that we create the right framework. So, you know, I think about regulation, and you know, in the sector I'm active in payments, you know, we've got the Bank of England, we've got the PSR, and we've got the FCA. Now, the PSR has as its remit promoting competition and innovation. So I think it's a really strong mandate for a regulator to have. But I think and that's not, I don't think there's an argument here about deregulation, because actually sometimes the right regulation can create a market. So we're talking about open banking. I mean, that was a policy regulatory initiative which helped create a market. And so I think one of the things we need to do is to be forward-looking. Think about how do you create the right boundaries that will actually encourage business to flourish. You know, Sarah Breeden this morning was talking about CBDC. So I'm thinking, okay, so if we're going to create a retail or a wholesale CBDC, being clear about the right platforms, the right innovation, how do you make that part of the wider payment structure, will help foster innovation. So I think it's been about being very mindful about where you create the right regulatory framework and how you do it, and how you perhaps move away a bit. I think it's something that Joe Garner talked about in his payments review. From being too prescriptive, let's be a bit more outcomes focused as regulators, and leave it to industry a bit more to decide how to deliver those outcomes.
Yeah, I think that's a very good point. Kaushalya, we were talking earlier about the opportunity in the short term, given the US elections ahead and the lack of clarity there in some of these areas. And I think you had some interesting points you'd like to make.
Yeah, I mean, I have some views, and you know, not maybe necessarily that is sort of the mainstream view of it. But I think what history tells us for sure is that the US, regardless of the geopolitical kind of uncertainty, has had a very vibrant and thriving private sector market, which has actually helped it to still carry on defending itself as, you know, leading player in the mature market scene when it comes to FinTech. And that is because of the ecosystem that it represents. You've got banks, you've got venture capital firms, you've got sovereign wealth funds, and all of them who are sort of investing into the ecosystem that are kind of decoupled from the regulatory, should I say the geopolitical scene. But that being said, one of the things that we have actually noticed, particularly in the last 6 to 9 months, is there's been a great interest and influx and inward interest for US investors to have exposure outside of their home market, largely down to the fact that they want to have a diversified portfolio. And that's definitely benefiting us from a funds of funds perspective, where they're looking to invest into funds like ourselves. So I think that's a very positive spectrum in terms of setting the scene. In terms of the UK itself, definitely it goes without saying there is a huge amount of opportunity for us, not just to leapfrog, but I mean, we are already there, but to get even further ahead. There are a few things that I think, as it's also been mentioned, from a regulatory perspective, I think there's perhaps a little bit more we can do in terms of, there's been a great momentum around the regulatory sandbox, but can we expand that beyond where it's currently constructed? So to include specific targeted incentive plans and support systems and compliance framework for the emerging and new technologies such as AI and DeFi and the like. So that's perhaps one area, particularly because the US and some of the other mainstream markets may not necessarily have the same view or much more of a progressive view on these things. So I think that's one area. Certainly the other one is, I think collectively as an ecosystem, I think we need to be attending and promoting the UK as well as a world's, the leading player in FinTech, particularly thanks to all of the lessons that we have learned over time. So showcasing those and talking through our lessons and making sure that we put that there. And then last but not least, I would say, also from attraction of the talent pool and the investor base, is also talking about how stable and how predictable the UK market is actually. Because if you think about it from a Fed perspective, there's always been this uncertainty, but when it comes to the Bank of England and various other, there has been huge amount of collaboration amongst the Bank of England, the PRA, the PSR, the various associations and the whole ecosystem as a whole. So I think it is the last point is I think is a very critical one for us to continue to collaborate.
I agree, and actually, even though the UK is in the year of elections, I don't think from a FinTech perspective we worry too much about that. I said earlier as I started this panel, which is very short and the time is running down quickly, that a huge amount has been accomplished, particularly in the retail banking space. As we celebrate the 10-year anniversary of Innovate Finance, my own particular interest lies much more in the investment banking space and the movement of FinTech from retail banking into wholesale banking. I'm looking forward to the story about the digital bonds, digital securities market, blockchain, AI in the UK. That's my wish for the next 10 years for Innovate Finance. William, what would be yours?
So I want to give a shout out to the regions, because we sometimes become too London-centric. And as Lord Mayor, I went to Edinburgh, Glasgow, Leeds, which is very good in RegTech, Cardiff, Bristol. Northern Ireland has a very good FinTech ecosystem. So what we've managed to create within the whole of the UK is we've spread out and we've got talent throughout the whole of the UK. And I think that's one of our biggest strengths as well as we talk about the ecosystem, the rule of law, what we have here in the city, which is very powerful as well.
Absolutely, and I think that is bound to continue.
Yeah.
It is, but I think what you need to do, and you talk about the success of the retail sector, is think about barriers to entry. So how easy is it for firms to access payment systems? How easy is it for them to acquire customers? And perhaps that's one of the things that we need to think about if you're concerned about the investment banking market, is what is it we can learn from the growth of innovation in retail payments and banking that we can apply to these sectors. And it's, none of these things happen by chance. The fact that the bank-owned payment systems came under independent governance of Pay.UK created easier access than if people had to access these payment systems through their banks. So trying to get the right policy levers in place, I think is a really important way of being able to spread innovation. And William's right. You think about the number of fintechs outside London. It's a real success story.
That's an amazing success story. Kaushalya, have you got any last wish in our 1 minute 30?
I mean, I sort of echo what has already been said. I think, a lot of the time we do focus on London being the central hub, and I think it will continue to, play a very leading role. But I think there's a lot of regional stuff that has to be brought to the fore. And, some of the team are here, and Phil in particular, one of our founding partners, is actually leading a particular effort around beyond investing, which is actually bringing this ecosystem of regions together and beyond London, and working together with the likes of CFIT and Innovate Finance and the whole ecosystem. And I think that needs to be given as, it's already been said, that needs to be a shout out for that. I think there's a great number of companies, very interesting companies that are coming out of the regions.
Any last words, William, on...
Yeah, I mean, I would have to give a shout out to Nick Lyons' Mansion House Compact and the Chancellor, and how, let's hope we follow through. 11 companies have signed up. 5% of their assets under management go into, private investments. And let's hope that really does happen, because we need to scale up much better than we've done so far.
Mark?
I think the point that William makes about scaling up and about access to capital just goes back to having a very deliberate strategy to think about how do you create the opportunities for growth in the sector. This doesn't happen by chance. People have thought this through. I always very wary about talking about industrial strategy. It's something that doesn't feel quite right to me. But actually, if you have a plan and understanding what makes success, then you're much more likely to lead to growth in sectors like this than if you leave it entirely to chance.
Well, I think that's a great way to end this panel. Thank you very much, all of you. Thank you, and to the next 10 years. Thank you.
Thank you so much, Sharon, for that great moderating job. Thank you all very much. You're very welcome to leave the stage this way. Thank you so much. So now we're going to move on to our next session. As the markets wait for IPOs to return and companies stay private for longer, is there a missing link between private and public capital markets? We're going to be discussing that with our next two speakers, so please welcome to the stage the CEO of the London Stock Exchange, Julia Hogan, and Joy McKnight, former editor of The Banker. Please welcome them to the stage.
Thanks so much for joining me, Julia. Pleasure. Thanks to everyone for joining us for this session. And of course, what we're going to look at is how to bridge the liquidity gap for scaling fintechs. Let's just dive right in, I think. So what is the state of play for the private markets in the UK today? What are the companies considering remaining? Why are companies considering to remain private for longer?
Well, I think it's been an existential issue for many years, in fact, and it's an exam question that we set ourselves at the London Stock Exchange a few years ago. And interestingly, anybody who's seen Jamie Dimon's letter to shareholders that was published, I think, last week, he made exactly the same comments about the relative size of the private markets compared to the public markets in the US, as we think about in the UK. Now, we've taken a very different approach at London Stock Exchange, which is basically to say, stock exchanges are at their heart conveners. Our job is to bring together those who have capital with those who need capital in service of an objective. And venues are great big network effects. What they facilitate is the ability to transact with trust at pace and at scale. Now, that should be possible and useful for a company at every stage of its journey. And I think one of the challenges we've had in the UK has been, and actually around the world actually, has been the private market has grown rapidly. It's become a very attractive source of capital for companies. They are choosing to stay private for longer, and I'll get into a little bit of the dynamics around that. But we also have a private markets are from Mars and public markets are from Venus sort of type thing, and that ne'er the twain shall meet. And I used to say that actually very often the only thing that's in common between the operations of a private market and a public market are actually the company going through the processes, not the people, the language, the processes, the mechanisms. We shouldn't have a system that has that many cliff edges that makes it so difficult to navigate. And I think that's one of the things that we're seeking to do in the UK now, and that's slightly the leading question, I think, behind this panel. The reality is I think the private markets have grown, and they are not just a function of interest rates. They're an existential temporal thing that is here and is here to stay. But one of the things I think we miss is that public markets have an awful lot of value as well. One of the things I'm most proud about what happened in the UK is in the first 4 months of COVID, and if you think about the time of COVID, that was just after results were going stale, it was when auditors needed to get in, it was when companies all of a sudden were burning through working capital at a huge rate of knots because they'd had to shutter their activities. In the UK, in the first 4 months, we raised more follow-on capital for listed companies than the next 5 European venues combined, because the entire UK ecosystem mobilized to make it easier and possible for companies to raise capital. There's been 7 billion of capital raised year to date this year. You wouldn't have seen that from the media, I think, because they focused on IPOs alone, by 90 different companies already this year at pretty small discounts. So the public markets have a huge role to play in keeping visions to be financed as you go through. The private markets, I think, right now, because of valuations, because of where rates have been, are actually finding some of those funds are finding it harder to follow their money. And so it illustrates the value of having private and public markets live together, but we need to make the interlinkage between the two much more seamless than we've had historically, I think.
But what about if there's been this whole move to be private for longer, how has that actually impacted? And you addressed it a little bit there, but how has that impacted the public markets in terms of IPOs? Because like last year, for example, in the UK, the IPO market fell by 40% by proceeds, 49% by number of listings, whereas the number of IPOs in the US and the Americas, for example, grew by about 15%. So UK specific, how do you think that's affecting the public markets?
I think we had, like most other venues in the world, an enormous growth of IPO issuance in 2021. We had an absolutely banner year. We had 2 quiet years thereafter. But actually, relatively in the US, the relative decline in the UK and the US was kind of the same last year as it had been the previous year. And so that context is often missed from the conversation. The key issue is we're seeing a pipeline that's building now and is actually pretty positive. We are about to go through the most radical reform of our listing rules in 40 years, which should be through in the middle of this year. So we've seen a number of companies wait until those rules and those reforms are through before they're coming through. But the pipeline is actually building and reasonably healthy. But that temporal issue between private and public has been here for many years. I think the key issue now is the UK is probably the first place in the world that's actually looking to connect the dots much more effectively between the two markets.
Excellent. So let's talk about that, actually. So the LSE is creating the first crossover market between private and public capital markets, an intermittent trading venue called Pisces, which...
I'll spell out, don't worry, you don't need to.
I'll let you do that. So can you give us a bit more of an update on what's happening and then how will it actually work?
Yeah, well, I think, actually, let's take a step back and say the UK is creating the regulation by which the LSE can build this market, and other operators could also build this market. And it is a world first. It is essentially the idea that you can create a regulated crossover market between the private and the public. Now, Pisces stands for the Private Intermittent Securities and Capital Exchange System Regulation. The R in Pisces is silent. I don't think I've ever said that before, but I think that's what it is. And the idea is to create a mechanism. Think of it as a primary application by a company to have an auction of their secondary shares as a private company. It creates an intermittent, transparent price formation process for a company to have an auction of their secondary shares at a periodicity of their choosing. So once a month, once a quarter, once every 6 months, once a year. What that will enable, therefore, is angel and seed investors to have a transparent price formation process to know at what price they're getting out. William just mentioned the Mansion House Compact, all those pension funds and institutions in the UK who do want to buy private companies. This enables them to use their pipes and plumbing to be able to buy and start participating in owning private assets. It gives VCs and Ps another exit strategy, so they don't force a company into a trade sale or indeed an IPO ahead of their time. That may sound odd coming from the CEO of the LSE, but I used to be an issuer. I care passionately about issuer agency and companies having the ability to set their own path and make their own decisions. And finally, it will provide the opportunity for liquidity for staff. So one hopes that particularly in a vibrant sector like FinTech, where we're in a global war for talent, then actually companies that are using this market will be more attractive employers than those that don't, because they'll be able to provide some liquidity in the ownership of the shares of the company. And so the logic is that we already have the most vibrant VC community in Europe. Huge amount of capital is deployed here. But we actually need to grow our own domestic investor base and the dynamism of it. And by taking this step of inserting this liquidity mechanism bespoke into the UK, available for UK companies and indeed companies around the world, then we're actually seeking to do something different to produce a more dynamic outcome. And it is the ability to have a genuine funding continuum all the way through in terms of venue provision for companies as they grow and as they scale.
Excellent. And you touched on it a little bit there about the regulatory environment that needs to be in place.
Yep.
Can you touch on that a bit more?
Yeah. So this regulation is now on its third name, I think. So it started off as a concept called MTF Lite in the Wholesale Market Review. It then was known as ITV, or the Intermittent Trading Venue, for quite a long time, before it was renamed by the government as Pisces. I think we're sticking with Pisces. I think I don't need to come up with any more, or we won't come up with any more. But fundamentally, the reason no other country in the world has done this is it's tricky. It's difficult. It means you have to deliberately toggle on and toggle off certain things. And actually, the rulemaking power and sandbox powers that the FCA now has as a consequence of the Financial Services and Markets Bill, or Act, has actually enabled this to happen. So with the spring statement that the Chancellor made, published with that was the Pisces policy paper that outlines the UK's proposed rules for this. The deadline for it is Wednesday, so clock's ticking. And then the hope is that the more policy work happens through the year, and then the FCA sandbox will be up and running at the end of this year.
Excellent. Okay, and then I also know that the LSE has partnered with Flow, with two Ws, which is touted as an all-in-one platform for scaling companies, VCs, and investors. And I think the partnership has been going on for a couple of years now. But how does this partnership really support early-stage companies?
So the logic of the funding continuum that we've talked about, and we set ourselves, and this is a matter of public record, the vision statement to be the first exchange in the world that was genuinely indifferent as to whether a company was public or private. Because my view was, if you think about what a venue can do, then that has value at every stage of a company's life. And the only reason we'd never done it before was because we'd never done it before. That, to me, wasn't a good enough reason. And it wasn't to any of my colleagues as we were working through this logic. And so Flow is a vital component of that, because fundamentally that is taking the same venue principles, facilitating direct issuance or intermediated issuance and fund issuance or fund investment into private companies, enabling them to make it easier for them to make themselves visible to investors, and also making it easier for investors to manage their portfolios. So it's taking the same principle of what we do as a venue in the pure play public markets and saying, how do we provide that service in the private markets? And then if you have Pisces in the middle, you have genuine connective tissue between them. And the logic is, for me, that the hardest thing any founder does should be coming up with a great idea and executing it. It shouldn't be trying to figure out the world of navigating how to get the capital to finance it. And this is about the UK creating the most possible enabling space to enable that seed and then venture and more mature stages of investment to be available for UK companies.
And how much of a boost do you think that's going to give the whole ecosystem?
Well, I think it's a critical piece of the puzzle, because you're creating a changed liquidity dynamic. And it is frustrating, and I think we've seen it. If you look at some of the Scale Up Institute, and I think Innovate's found exactly this, the amount of capital that great UK scaling companies have taken from overseas. Now, that's great, and that's really high quality capital coming with very high quality advice as well. But we have the second largest pool of institutional investment in the world in this country. We should be able to direct it to our own scaling companies. And we have this kind of principle in the Capital Markets Industry Task Force that I have the privilege of chairing, which how do we create consequential companies in the UK? So the CMIT vision statement is, how do we create the best possible environment in this country for great companies to start here, grow here, scale here, and stay here. But scaling and staying here means you have to continuously have ongoing access to the capital that you need to fulfill your ambition. And to become globally consequential from the UK. So the UK needs to make sure that that ecosystem is working. And that the combination of the Edinburgh reforms, everything that we're doing on CMIT, and the creation of Pisces is all deliberately designed to join all these things up and make them as efficient as possible and effective as possible.
Okay, I think we have enough time for two more questions.
Okay.
But what will these developments really mean for UK's competitiveness on an international scale?
Yep.
We talk about the government's ambitions to become a science and tech superpower by 2030, the right to have the right environment for our own UK tech giants. What do you think this will play into that?
Well, I think the remarkable thing about all the reforms that are going on at the moment, and we in CMIT talk about this concept of 5 fingers on a glove. So primary market rules, quality of sell-side research, availability of risk capital, corporate governance and remuneration, and the ecosystem for scaling consequential private companies. And the glove is the culture, how we talk about it around here, how we celebrate entrepreneurship. We're making progress on all of those 5 fingers in terms of reforms right now, whether that's the FCA reforms, whether that's pension capital reforms, pension reforms, Mansion House Compact, whether that's the conversations that are very different about remuneration this season than they've been in previous seasons, or whether that's creation of PICES. We're making progress on all of those things. And the UK has remarkable raw ingredients. We have more cutting-edge science coming out of our universities per capita or GDP than any other country. We create more unicorns than anywhere outside the US and China. We have a world-leading capital market on a multi-asset basis by any measure. If we can just get better at connecting all of those things together, then we can really create even more dynamism and ultimately growth and productivity for the economy. But it isn't about doing the same things over and over again and expecting a different result. It's about actually quite deliberatively changing bits of the ecosystem and making sure that they all coherently connect together. I've seen quite a lot of comment over the years about review-itis. Actually, all of this reform agenda does connect together. If you think about PICES and then you think about the Mansion House Compact, well, fundamentally, PICES is the mechanism by which the Mansion House Compact works. You know? These have all actually been connected together, but in a way that I think it's not always easy for people to see the totality of the ecosystem at one time.
Okay, my last question. So the focus on private markets, what's next for the London Stock Exchange?
Well, there's a fair amount to continue to execute. I mean, I have started giving speeches this year to say that actually I think there's a very good chance that we can look back on 2024 as the year that really moved the dial. And if somebody had told me 3 years ago that we'd be where we are today on the reform agenda, I'm not certain I would have believed them. But the issue is London has continuously innovated and continuously evolved to be the financial services capital. And if you look at the idea that was behind the sandboxes that the FCA created and the scale of the FinTech community we have now, and then you think about all of these other groundwork that we're laying, the Unicorn Council being able to create that real cohesion around what the unicorn population need. Now, there are various things that are next on the agenda. There's still bits of the core agenda that I think we need to pick up. One of the cudgels is the issue around stamp duty, which I know was raised this morning as well. But fundamentally, that is a friction in our system. And I think we need to change the narrative about it and understand that it's not a fat cat tax. It actually taxes the average retail consumer on the street and their pension funds. And therefore, we need to think about how we can replace that money for the Treasury, but ultimately look at restructuring that to increase the dynamism in the market. So there are still some parts of our market ecosystem that we need to think about. I also have the privilege of building our digital assets infrastructure for LSEG as well. And actually the potential for that to transform the functionality and the delivery and the efficiency with which our markets operate. And I think the UK's potential to be at the centre of that is also very exciting. So there's a massive reform agenda going on.
Excellent. Well, thank you so much, Julia.
Pleasure. Thank you very much.
Thank you so much, Joy and Julia. Fascinating discussion. We're going to talk a little about the investment trends to watch now. And we know the landscape has been tough for IPOs. It's also been challenging for investment. We've been hearing it on a number of occasions today. We've seen a significant fall in total FinTech investment in 2023. But now we're in the spring of 2024, so are we seeing the shoots of recovery? And let me just take a quick poll here in the room before I introduce our next panel. Show of hands here if you think we're seeing a thawing in the IPO market this year. Show of hands if you think it's still quite bleak. Okay, all right, well, interesting. Well, I'm delighted to welcome our moderator for this next panel, Rebecca Burford, who is the head of Tech Venture Capital for the UK at the law firm Gowling WLG. So please welcome Rebecca and her panelists.
Hi, well, afternoon, everybody. Hope you've been enjoying your time here so far. As mentioned, we're going to be talking about investment trends to watch for 2024. So I'm Rebecca Burford. I'm a partner at Gowling WLG and head up their tech venture capital team. And I'm joined by an amazing panel today. We're going to have a really interesting discussion. So just going down the line, if you could introduce yourself, that would be great.
My name is Tim Levine. I'm the CEO and founder of Augmentum FinTech, which is the UK's only publicly listed FinTech venture fund.
Kevin Chong, I'm sort of founder and general partner at Outward PC. We're an early stage FinTech and investor in FinTech and connected sectors.
Steve Gibson, I'm a partner at 13 Books Capital, and we too are early stage FinTech investors.
Hi, I'm Sophie Winwood. I'm operating partner at, an early stage FinTech VC. We focus on Europe and the US. I'm also the CEO and co-founder of WVC, which is a community promoting, including and empowering women in VC globally.
That's brilliant. And we've got a really broad range today, which is fantastic in terms of the check size that's written. It ranges from 250K through to 10 million. Across a broad church of round sizes, from a couple of 100,000 through to hundreds of millions. So great section there. So we hear a lot about the winter of 2023. We know it's been a really tough climate. It'd be interesting to hear how Q1 has gone for each of you so far, and what are you feeling? What's the sentiment for 2024 looking like?
So I think you asked me that question at a good time because we had our Q1 review this morning. So in terms of companies that we've engaged with in our pipeline, it was up 65% on Q4 of 23. So I think the year has started off with more momentum. I think that was expected. I think the question is that momentum going to continue? I think some of us who are on this panel last year, we talked about how challenging 23 was relative to 21 and 22, and I think we discussed that those were anomaly years, years that won't be seen potentially ever again, and I think we need to look back to 2018 and 2019, and I think the industry is in good health, and we'll talk a little bit about the capital available, but 24 should be a stronger year than 23, but I think the momentum is behind us and the capital is there. So I think over the next couple of years we will see record years once you take out the anomaly years of 21 and 22.
And Kevin, are you finding a similar story?
Yeah, I think very similar to what Tim was saying. I think that definitely the pipeline has picked up significantly. We're only 3 months into the year. I think it's definitely looking a lot better than second half of last year. I mean, personally, I think it's a really exciting time to be investing, to be a founder in this environment, because I think what we're going to, and it's not just about 24. I think it's 25 as well. I think these next couple of years we're going to see companies, fintechs being built that are going to be a lot more sustainable. They're going to be sort of wider as well in terms of their focus, and also they're going to be focusing on a lot on areas that are going to be a lot more profitable than what we've seen in the last generation of fintech.
Yeah, I agree with everything said thus far. I mean, I think the 22-23 bubble is a bit of a 21-22 bubble is a bit of a sort of micro moment, but the sort of more macro trend is that really smart young founders every day want to start their own companies and build their own version of something better in these markets. Financial services is still the biggest profit pool in all the industries you can be building into. And the quality of founders coming through over a 5-10 year period, and the number of founders coming through over that period is just going up and up and up. And I think what you can see in Q1 is people have stayed out of the market for a while, quite rightly. And what you now see is them coming back in Q1. So the quality has gone up, and certainly the volume. I think we're all really busy at the moment. And there's a lot less capital for European fintech founders right now, so the market's moving more slowly, but the quality is definitely still there.
The quality's there, that's good.
Yeah, for sure.
And Sophie, Q1 for you?
Yeah, I think at the start of Q1, I'm in a sort of women in FinTech WhatsApp group, and someone put on the WhatsApp group, does anyone have any reports saying that FinTech isn't dead, please? But I think, now we're all looking a little more positive. Everyone's back to that kind of bleary-eyed busyness, which is a good thing. And as we've been saying, we're actually seeing really quality founders jumping out of fantastic, stable jobs at either incumbents or the kind of tech challengers who are just like, yeah, this needs to be solved. And I feel like this stat gets quoted a lot, but FinTech is only 10% of the financial services industry. So we still have a huge amount to go after in terms of pie. So I think given that we now have a bit more data about the FinTech 1.0, what works in terms of we're seeing challenger banks are working, maybe robo-advisors aren't, then actually that next generation of FinTech builders can really see actually, this is the area that there's still white space, and this is the area that we don't want to go on because it's busy or consolidating.
It's interesting you talk about FinTech. I think just taking a step back, how do your funds define FinTech, Tim? Is it broad? Is it narrow?
It's as broad as you want it to be. I think if we asked everyone in the room what they define as FinTech, we'd get a couple of hundred different answers. I think, for us, and for many of my kind of peers in the VC space, we will bucket, InsurTech, RegTech, traditional kind of FinTech under the same umbrella. And then there are some really interesting emerging areas where there is a real intersection. Climate is an area that we're looking very closely at, where that does intersect with FinTech, whether it's energy trading, whether it's data analytics. These are all areas that we really feel are, if not financial services adjacent. And I think we feel we've got that expertise that can really lend itself. So I think, that's for us. It is a much broader market when we define it as pure financial services. But as Sophie said, the market is still significantly underpenetrated. And if you just look at pure revenue, we're talking about a $15 trillion global revenue opportunity in traditional financial services, of which FinTech revenues we think are about 350, 400 billion, so single digits. So this is an industry that has a long way to go. There are going to be hundreds of multi-billion-dollar businesses built over the next decade, hopefully many of which in Europe, in particular in the UK. And I think that's what excites us all around the table, that the opportunity is ahead of us, despite the fact that we've been on a sentiment roller coaster over the last 24 months.
Yeah, it's interesting. And Kevin, just from your perspective, that cross-section between FinTech and other industries and what you're seeing, some of the investment opportunities that you're coming across and what's exciting you?
Yeah, good question. I mean, in our case, we've always been a fund that where we try and imagine what financial services is going to look like in the future, right? And when we do that, we start thinking about how it intersects with all the sort of big problems in the world right now. We think, and currently, these would be healthcare, education, climate, Web3 as well, and then we sort of imagine what the intersection is going to be. So I'll give you an example. I mean, if you think about healthcare, obviously, we're living in an age where people living longer, they're getting older, they're working for longer, and you've got an environment where the public health systems are failing. Where's the sort of FinTech angle in that? Which inevitably, I think it's going to be about the solution is going to be employer provided, some sort of insurance. PMI hasn't changed in decades, so we take all of that into the mix, and then we think about when we look at a startup, the important thing for us is it at the right stage, and then it's sort of as a secondary thing. We think about, does it fit into that framework that I've just talked about? Like, is there an intersection between FinTech and these big problems in the world? So in our case, it is broad. There is some method to it, but what we say to founders when we meet them is like, just tell us if you're at the right stage for us, and let us decide if it's FinTech.
Yeah, no, thank you. That's really helpful. So Sophie, you invest across Europe and also US, is that right?
Yep.
Yeah, so historically, I think the UK and the concentration of fintech companies was really strong. Are you seeing any trends around that expanding into Europe more and the UK not being the centre?
Yeah, I think I am. I say that with hesitation because I work for Innovate Finance, and I think one of the beauties of London is that we are this hub for innovation, and we have been seen as the global leader of fintech. One thing we say is, isn't it amazing that you can walk from a VC office to the government, to the Treasury, to a bank within sort of 20 minutes, and that really kind of enables this network effect to grow. And I think we are still benefiting from that, but we need to not get complacent. I think all of us are seeing a shift in terms of our investment, the companies we're seeing, and our investment volume broadening across Europe. Tim was saying if you go to Paris now, you can feel that buzz. We've seen some incredible companies raise rounds, really significant rounds for fantastic businesses. And so I think that's a great thing for fintech because that's what we want. We want it to grow, we want it to diversify. But as a kind of born and bred Londoner, I would love to kind of see us maintain our crown, and I think that requires a lot of focus from great initiatives like Innovate Finance to the government support, to kind of just making sure that there's enough capital available.
So more competition now, effectively.
Yeah.
Yeah. And so Steve and Kevin, you're currently raising funds at the moment. How's that? Is it challenging?
I'll let Steve go first.
Well, I mean, there's, I think in every asset class right now, there's less liquidity and there's less funds available no matter who you are and what you do. If you're a founder sitting in this room or you're a VC raising money almost on behalf of founders. But I think relative to 2018, 2019, it feels similar. Relative to 21, 22, it obviously isn't. But if I think about our portfolio, generally the process of less capital being available has really focused people on building much tighter, operationally focused business models. And I think it is a fact that the best companies come out of tough periods. So I think this is okay, but it is obviously a fact that there is less money available for venture firms and founders of venture firms. And therefore, when you're in that market, you have to be absolutely ready for that. You have to be really on your game. You have to know exactly who you are and what you're asking for, and you have to have very good information about the claims you're making. So I think if you're building a business over the next 15 years, you're going to go through many oscillations where the market is kind to you and the market is not so kind to you, and you've just got to be ready for that.
Yeah, it's a tough climate, but there's still capital out there.
Yeah, I mean, I think the good news is, relative to 18 and 19, we've got far more dry powder than we've had arguably at any previous point in history other than the anomaly years. And I think when you have too much capital in the market being given to too many companies at too high a price, you see a lot of ill discipline in the market. And I think we've seen a reversion to what we think are the right type of founders who are behaving responsibly, recognizing that they need a path to profitability. We're not looking for profitability on day one. We want to really help these businesses scale. And I think that recognition has taken some time, I would say, for the fintech community to come to terms with from 21 and first half of 22. But I think we're seeing a very different approach, mentality from founders. I think investors are kind of articulating what they're looking for. And that's where you'll see some fantastic businesses being built, where you have scrappier founders with less capital having to prove more in a shorter period of time. But ultimately, history will show you that in these troughs or relative troughs, that's when those great outcomes have happened. And we only need to point to 2012, but 2008 in particular, where you saw some extraordinary outlier tech stories. And I think we're going to see some phenomenal businesses come out of 24 and 25. Arguably could be one of the best vintages, certainly in fintech in Europe, that we've seen.
Yeah.
I think generally what's great about the current environment, I mean, whether you're a founder, whether you're talking about investors, you're talking about LPs and funds, people who are active in the market right now are just so much more committed than they were, in 21, 22 when money was free flowing, right? I think the people who are doing it right now are doing it for the right reasons. The investors in the funds are much more active in terms of supporting the companies. For all those reasons, you've got all the right ingredients right now to be both building a fintech and investing.
And just to add to that, I think the other thing that we're seeing is that during the highs of 2021, you had a lot of people piling into fintech who were more generalists, and they have subsequently got burnt. And so, but all of us, we were there in the hard times. We stayed. We were staying investing in fintech when everyone was running away.
And you're still here.
Exactly. And I think that you're now getting a better understanding of like who really understands fintech, who sees the potential, who gets a lot of work, and there's this horrible regulatory bit and different dynamics in terms of unit economics. But that on a good side, that's you'll get an investor that understands your business model, that'll be able to help, and will kind of foresee some of these risks that will come up.
It's interesting. So there's capital available. We've got fintech experts. So you need a fintech fund. But what about valuations? What are we seeing in 2024? How has everything we've heard impacted that?
Yeah, I mean, I think valuations have clearly come down from the highs. We're still seeing outliers, for sure. But I think there has been a narrowing of the bid and the offer amongst the investor community and the founder fintech community. And I think investors are looking for different characteristics perhaps than what they were looking for 2 or 3 years ago, or I should say certain investors were looking for 2 and 3 years ago. I think there is more discipline. We are quite valuation focused, and we walked away from a huge amount in 21 and 22. We're still kind of being outbid in parts by funds where I talked a little bit about the intersection with climate. You've got dedicated climate funds, you've got AI funds that are still arguably overpaying, and I would say AI is at the top of the hype cycle at the moment. But I think those pure play fintech opportunities, we are seeing relative value, and that's why, I do think the vintage should be very strong over the next, 2 to 3 years. As a result, I think when you have more realistic founder community in the fintech ecosystem and investors that remain disciplined, that's when you start to see the kind of those returns flow through, which we're not going to see as the norm from those vintages in 21 and 22.
I think sort of going back to Kevin and Tim's point earlier, that the first version of fintech was very much about the digitization of traditional finance, credit, lending, banking, payments. Fintech now has sort of expanded into, the creator economy. How do you monetize gaming, digital markets? So like the expansion has been quite dramatic. When you think about the 90s, people used to call certain stocks internet stocks, and then every single company became an internet company. There was no more definition around, and that's the same for fintech. You can see a monetization event appearing in all sorts of industries that now that industry wants to own and commercialize in some way. And as a VC, you're looking always for white space. You're not looking for the 11th best payment firm so you can pile on 4 years late. You're looking for somebody that's being creative, ingenious, pioneering in these new markets. And in those markets, you definitely want a fintech partner to help you scale your business. But also those markets, they will have oscillations of valuations that make no sense to you because they're sort of outliers. So, this time last year we weren't talking about AI in the way that we're talking about it now, and all of a sudden there's a whole list of AI funds that are now competing with us in those markets, and that will continue to happen. So valuation oscillation will always be part of what we do. But if you're a founder, you want to pick the partner that's going to be there for you all the way through your journey. And I think that's generally the perspective we would have in the founder conversation when you're in those decisions.
Yeah, so I guess it's worth talking a little bit about follow-on funding and what are we currently seeing in terms of follow-ons? Are they difficult to close at the moment, or?
The follow-on market's an interesting one because what's happened is, and this is kind of specifically at the early stage, venture capital's like steps, right? So you raise money, you reach certain milestones, you raise money again, you reach certain milestones. And they have predefined terms and predefined investor types. And the seed to Series A jump has just got a lot harder. It needs a lot more capital to get there. It needs a lot more things to be figured out. Go-to-markets become expensive. You need to get the right talent. And so we're seeing a lot more bridge rounds or inside investor rounds between that seed and Series A. And the speed of that really depends. It depends if you go outside to other investors, they need to get to know the business. Is it like, I was going to swear there, crap, we're running out of business, we're running out of money next month, we need something very, very quickly. But I think everyone's a lot more cognizant of capital. You can't just click your fingers and get capital. Therefore, there is a lot more focus on forward planning, cash management, budgeting. And that is on us as investors as well to say, look, this is not the ride that you're used to, and we need to think 4, 5, 7, 10 steps ahead in terms of how you're bringing in that capital, having different plans. And so I think it really depends on a case-by-case basis.
Yeah.
Yeah, look, I think because there are going to be more bridge rounds being done in this environment, right? Fundamentally because people are all trying to extend their runways to get that little bit more validation, because you don't want to be sort of fundraising when you don't need to. And I think because of that, it's now becoming more important who you've got as investors on your cap table, because the people that are going to help you get those bridge rounds done and are going to be your existing investors. Whereas, in that sort of period, 21, 22, when money was free-flowing, sort of money was coming in from all directions. I think now it's just become that much more important. I think the choice of who you've got on your cap table, are they going to be supporting you through those next few rounds? And just, it could be bridge rounds, it could be a smaller Series A than you're expecting. It's now become that much more important. I think it was less important in 21, 22. It's much more important now.
Yeah, I think that's a really good point. Differentiation was less of a opportunity to convert in 22. It was just who could act quicker and pay the highest price. And we had a lot of debates with founders about why that wasn't a good thing. And I was on this stage 2 years ago saying the tide's about to go out. We're going to see who's swimming without their swim shorts. And I think we've seen that, and we've seen the disappearance of a number of funds who weren't in it for the long term. We've also seen a lot of corporate venture. In a bull market, they like to get involved with venture because it's fun and it's exciting and you can get their hands dirty, and then they realize they get their hands dirty and it's a lot harder than they thought, and then they all look for the parachute to get out of the market. And we've seen that as well. So I think for founders, it is so important for them not to just look at today, but do the due diligence on the money that you're taking. Are they going to be there during the tough times, and are they going to be there for the long term? Because it is a rare scenario where it's all plain sailing. I've been involved in so many businesses over the years, and even the most successful ones that have, thankfully ended up, with multi-billion-dollar outcomes, have had unbelievably challenging times on that journey. And if we hadn't have stood by them, or had investors that stood by us at the time when we were building them, it would have been a very different situation. And that's certainly a source of frustration for me over recent years, is that founders just haven't done as much due diligence on the investors as investors have done necessarily on the founders. And I think it's really important for both sides to really go in with their eyes open, because it's a marriage. It's a long journey. And it doesn't always end up with a great outcome, but you want partners who are going to stand by your side on that journey.
Yeah, fantastic. That's been really, really insightful. So I think FinTech experts that will take you through the journey, a bit of a realistic expectation around valuation. And I think one of the most important takeaways is that if you are a founder out there and you manage to do this in this climate, it is what we've heard is a vintage year, so you're all going to be unicorns.
Easy.
So, so thank you very much. your time today and all your wisdom. We really appreciate it.
Thank you.
Thank you.
Thank you very much. So apparently I am in a room full of future unicorns. That is really good to know. Thank you. Well, can you believe it? We are at the last panel of the day now. I know it's gone so fast. It's been a day of amazing conversations. Don't forget, we do have drinks after this panel, so do stay for those. So the last panel discusses one of the most important challenges facing finance today, cybersecurity. As we all know, cyber threats have never been more prolific because fraudsters are becoming more sophisticated. So how should the government and cybersecurity leaders contend with these growing global threats? What will it take to secure the UK's businesses and consumers? So please welcome our moderator for this panel, Danny Lopez, the CEO of Glasswall, and his panelists to the stage. Let's make them welcome.
Last session of the day. Thank you so much for being here. We'll try and keep it as pacey and as interesting as we can. We're going to cover cyber security, and I've got a wonderful panel I'm going to intro in a moment. But what's happened over the last year? Well, threats continue to surge, attacks are soaring. That's the reality of cyber today. Over the last 12 months, they surged by around 300%, depending what stat you're looking at, but it's never less than 300. And of course, the world has changed a lot in terms of the tech. We've got AI and Gen AI in particular playing a major role in cybersecurity. So how do leaders contend with the current cyber agenda, and how do we work to make sure that we can protect organizations and keep them safe? That's what we're going to cover in this panel, and let me do a very, very quick intro of our panel. To my left, we have Kate Pye, who is the Cyber Transformation Lead at PA Consulting, partner in digital trust and cybersecurity, and has widespread experience across policy, strategy, and transformation in defense and security. We have Andrew, Detective Chief Superintendent Andrew Gould from the City of London Police, also National Cybercrime Lead for National Police Chiefs Council, and a global cybercrime expert for Interpol. Nina Kerkes is the Senior Director of Strategy at LexisNexis Risk Solutions. I should say that I said I'm going to try my best to get LexisNexis right, and I did it, but there you go. With responsibility for strategy and innovation and fantastic expertise across financial crime, fraud, analytics, and credit risk. Phil Larratt is the UK Operations Manager at Chainalysis, previously Senior Manager at the National Crime Agency, and has been leading investigations for years now on cryptocurrency crime, which is hugely interesting and we'll get into in a moment. And last but not least, Barry O'Donoghue, CEO and co-founder of Radium, global expert in smart data and trust frameworks. Barry has also helped steer the delivery of open banking and open finance initiatives globally. So we've got 25 minutes or so and quite a lot to cover. So let's just get stuck in, and I'm going to start with Kate and ask you, Kate, how should companies of all sizes balance the need for digital transformation with also implementing a robust cybersecurity strategy?
Thanks, Danny. There are a couple of things in this for me. So cybersecurity and the digital transformation any organization goes through has to be for the purpose of whatever the business has as its core aim. If it's a bank, if it's an investment organization, that's what it's there for. It's not there to do something whizzy in cybersecurity or in digital. It's there so that the digital and the built-in cybersecurity aids its core purpose. So for me, it's about understanding what you need to do with digital transformation, building cybersecurity into that from the outset, because retrofitting it later is so much more difficult. But also now in this day and age, it's not just looking at the systems, processes, and people elements. It's looking at the data and the AI and how you want that data and AI to be able to aid your business and your decision making, so that you're building that in as well as the cybersecurity to your digital transformation strategy.
So cyber is never a standalone.
Cyber is never a standalone. Digital is never a standalone. They're both a method to get your core business done in the right way.
So out of interest, looking at the people in front of me, how many of you suffered some kind of attack, a cyber attack, over the last 12 months? This is a very lucky and fortunate crowd, I have to say.
How many of you didn't, just don't know about it?
That's the second question. And that is the key with so much of this. So perfect segue, thank you, Kate, to Andrew. Andrew, you're dealing with cyber challenges that you see on a daily basis for companies of all sizes. How well equipped do you think companies are to deal with the cyber threats that they face today? And based on the fact that you know that companies don't have masses of resources, where should they focus their resources based on what you're seeing landscape-wise right now?
It's a really good question. So, I mean, obviously different companies will have different approaches, but I think a lot of companies will take the approach of being over-reliant on their managed service provider or whoever their IT provider is. They'll ask some very basic questions. Have you got good cybersecurity? They'll get told, yeah, we've got very good cybersecurity. And they'll almost not have the confidence often to know what further questions to ask. So I think there's a real, people either ignore the problem, they're complacent about the problem, or they're very worried about it, and those that are often very worried about it are actually often in a very good place. I think a lot of organisations actually are in a stronger position than they realise. I think we probably, I don't think we over-egg the threat by any stretch. It's extremely serious, but I think actually we can get distracted by AI, deepfakes, quantum computing, all these myriad of different things that are happening almost at the speed of light, and just think, God, where do I start? I think for most organisations, just forget all that. It doesn't really matter where it's coming from. It doesn't really matter who's doing it, unless you're, certain niche organisations. Just concentrate on the basics. You will manage out 90% of this threat. We are actually much more capable and much better defended than we probably realise. We just need to help people feel a bit more confident to do the right thing.
And we'll come back later on to understanding what those basics look like. Because so much of this is about getting your cyber hygiene right, and
Absolutely.
the simplicity of it is actually the key to getting it right many times. We'll come back to that. Thank you, Andrew. Nina, at LexisNexis, you spend a lot of your time preventing fraud and cybercrime, but you also spend a lot of time stopping it. So based on what you've seen over the last 12 months or so, what lessons do you have to share from some of the case studies or kind of some of the experiences that you've had that would be beneficial for this audience?
Yeah, so I think what's really kind of coming out is the importance of a holistic view of identity when we are fighting criminals online or in sort of cyber and digital space. I'm not here to sell our product, but we do, one of the solutions that we have is really focused on digital identities. And when I talk about that, it's more about sort of device data and how people are behaving online rather than just digitizing physical identities, so your names, addresses, and so on. And kind of having that holistic view is really critical. So having both digitized data and digital identity data, so device data working together. Over the last year, we have worked with DCPCU, which is dedicated, I want to make sure I get this right, Dedicated Card and Payment Crime Unit, which is a kind of a joint venture between UK Finance, City of London Police, and Met Police. And we have been really sharing some of those digital attributes with them to identify mule networks online, and this has proven really successful. There were multiple arrests that came out of it. But what's really interesting in working with some of the agencies is that initially we used to focus on just one individual, one problem, one entity that is causing some challenges online. But even in those, in that focus, those anomalies being detected are actually showing that these are, of course, networks. It's never just one individual or one person. So we have managed to identify mule herders. So these are people that recruit and control those networks, which has led to multiple arrests. So kind of really interesting to observe that work that is happening with digital attributes being accessible to the agencies.
Thank you. And that's really helpful because, again, we'll come back later to actually unpacking some of those threats. Phil, we've run this cyber session for, is that rain?
Yep.
Yeah. Well, no leaks, we're fine, so the show goes on. We hope. Phil, we've had a cyber panel now for a couple of years, and we haven't really spent much time talking about the impact of crypto. And indeed, as it becomes more and more widespread, how do you see that impacting the overall cyber threat landscape?
Yeah, it's a really good question. And I think I'm just going to take a step back first and just speak very briefly about blockchain analytics. So the company that I'm from, Chainalysis, we're a blockchain data platform. And essentially what we do is we collect data from the blockchain and from other sources, and then analyze that data. So we run our own algorithms, our own heuristics across this data set. And then we look to attribute these addresses to real-world entities. So if you've got a 30,000-foot view of the blockchain, essentially you'll see a variety of different entities. Some of them are legitimate, such as exchange and peer-to-peer traders, merchant service providers. But then there are these sort of illicit entities as well. So fraud shops, darknet markets, ransomware, so on and so forth. So we're in a really good position at Chainalysis. We've been in the business now for 10 years doing this, of attributing these different entities. So we can see trends across the sort of cybercrime ecosystem. So let's just look at a few. Every year we release something called the Crypto Crime Report. And last year, 2023, we saw, for example, a decrease in hacking. So in 2022, it was about 3.7 billion lost as a result of hacks, exchange hacks, exploits in relation to sort of DeFi protocols. And then in 2023, that actually decreased to 1.7 billion. So overall, that's good news. Now, contrast that to ransomware. So again, using our data, we can map these trends over the last sort of 5, 6, 7 years. And we've seen, other than 2022, sort of a continuous increase. Now, 2023 was actually a record year for ransomware. So nearly $1.1 billion worth of cryptocurrency was paid to different ransomware actors. So these different variants that operate across the blockchain, across the ecosystem, that are extorting small, medium-sized businesses, multinational corporations, stealing data from healthcare sector, critical national infrastructure, so on, and so forth. Now, we can then sort of look beyond that data and start to ask the questions, well, why is this? And we can see that these different threat actors across different jurisdictions are really starting to ramp up. Hence, there's significant increase. I think it was 150% last year alone. So then that hopefully then informs strategies and crime prevention, particularly in relation to ransomware. But like I say, from that sort of 30,000 feet view, we can see there's been a huge increase over the last 12 months, owing to various different factors. The double extortion method, the lowering of the barriers to entry as well. I think it was Recorded Future who said that last year, I think it was 530 different variants of ransomware that had popped up in last year alone. So the landscape has changed. We've seen increased victimization and an increased level of targeting through big game hunting as well.
And we hear so much, don't we, about a lot of these organizations having their own marketing teams and providing flexible payments and essentially running like multinationals.
Exactly, they're very effective businesses that are bringing in hundreds of millions of pounds worth of funds, and they have their own HR departments almost, their own marketing campaigns. And we saw that recently with Lockbit. Lockbit was a brand. It was targeted and taken down. But the question remains as that how effective was that takedown? The initial indication is very, very promising, but there's still a lot of work to do.
Thanks, Phil. And we'll come back to blockchain a little later on. Barry, you spend a lot of time with central banks and regulators? Out of interest, are there any central bankers or regulators in the room? No? I think you can speak freely, although maybe if they're in the room, they wouldn't tell you. Even though cyber is not the 100% of your focus in any way, just interested from your work with them, what you observe in terms of how they build up cyber resilience excellence, because so much of the conversation that we're having is organizations of a certain size, but in a way, a lot of these organizations look up to the central banks and look up to the regulators for so many things. So what lessons can they take on cyber resilience?
Sure. So our customers, as you say, are central banks and sector regulators at one end of the spectrum. And they are investing in modernizing their financial infrastructure and transforming that through technologies like digital currencies, instant payments, open finance, et cetera, et cetera. And with that, they clearly have to bake in and build in cyber resilience from the get-go. So where do they start for that? They start by building on open international global standards that have been proven in multiple markets, that have formal security analysis papers that have mitigated all of the known threat vectors and angles. And that is a key part of what we at Radium have been doing, is both contributing to the development of those open international standards, but then applying them globally at a whole market level, right? So that means every FinTech or tech business across every licensed financial institution, every bank, every insurance company, every wealth business, for every consumer and every business every day. So you've got to get it right all the time at market scale. And therefore, you've got to use proven open international standards that have that established benchmark. So we've been pioneering the application here in the UK, and we've been building on that in other markets such as Brazil, in the Middle East, in Australia. And it's data agnostic, it's sector agnostic. And I think there's a huge opportunity. It's not just about building in resilience, but there's a huge opportunity for demonstrating trust and confidence on the global stage, and to drive innovation and growth and accelerate. So I think that's right there.
Good, thank you. And what we'll in the second round, we'll maybe talk a little bit more about those standards and how the UK compares to the rest of the world. So we have time for round two for each of you. Kate, you alluded to this in a way earlier, but it would be great to hear from you a little bit more about whether cybersecurity is just the art of protecting organizations, or whether it's an integral part of a digital growth strategy. And if it's the latter, then maybe you can talk us through some examples where that has been done very well, and what does integral really mean in terms of getting it right?
Yeah, you're quite right. I think it's integral to the digital growth strategy. And every business's growth now is a digital growth strategy. We live in a digital world. So it's kind of a non-negotiable that you need to do that in a safe and secure way. Otherwise, your customers, your clients are all going to vote with their feet pretty quickly. And we've also seen this in the shift, particularly in the cloud providers, but more broadly than that, from secure by design to secure by default, which has been driven by the US and is looking at, well, you should expect that the services provided to you as an organization are secure by default. So that's up to the large providers to give that to you. When you're looking at who does it well and what does good look like, there's a balance in protecting your organization between prevention and resilience. And the quip I made earlier around how many organizations have been attacked and just don't know it yet, as an organization, you have to be lucky every time. If you can rely on being lucky every time, great. But actually, resilience is more and more important, because that's what's going to build into your business, ideally, the ability to be anti-fragile, so that through going through an attack, through going through a disruptive event, your organization is stronger coming out of the back of that. So if you can design that level of resilience into your organization, you don't have to be lucky every time, because you come out of an attack or an event as a stronger organization, better able to cope with the future. So those are the organizations now that are taking more and more of the lead in terms of what they're doing.
Yeah, I mean, it's such a good point, and I always find for those of us who do cybersecurity on a daily basis that people tend to accuse us of being scaremongering and just sort of, generating fear. And it's not about that. I mean, it really is just the reality of running your business on a daily basis. And as you say, learning from it, but also your customers and your clients will feel far better if they know that you're learning from it, because that's the basis for digital trust, which you speak a lot about.
Yeah, and of course you need systems that are secure by design, but you need processes that encourage compliance rather than consent and evade, because we're all human. We'll all try and find an easier, in our view, way of doing things. And people with a cyber-savvy mindset, so they understand what's important to your type of organization and what they individually need to do about that. And those are the things that if you can build that in together, then do the planning and exercising so you know what to do as an organization and as individuals in the event of a cyber attack, you're much further forward in terms of being a resilient organization and keeping the digital trust that your clients put in you.
Thank you. So let's assume that companies won't be lucky every time. So Andrew, thinking about getting those basics right, there is a myriad of information out there. Some of it is very good. City of London Police, NCSC, National Cybersecurity Centre, recently a platform that's I was shown the other day called the London Cyber Resilience Centre. Again, very, very good. What recommendations do you have for everybody in this room when it comes to just getting your cyber hygiene right, the basics?
Okay, so I guess in terms of kind of the current threats and what people are worrying about, we're seeing, as Phil said, 2023 was the year of ransomware, as every year seems to be for the last few years, but biggest in history. What we've also seen is almost maybe a shift away from phishing, more a shift towards a lot of internet-facing applications and such like, just full of vulnerabilities, and those vulnerabilities being exploited at a very, very basic level. I mean, we're still in 2024 talking about some real basics. On the one hand, that's disappointing, but also putting a more optimistic spin on it. A lot of this is still very easily organized out. We talk about AI and trends in AI. I don't think we're seeing a huge shift for criminals moving into AI at the moment. I think a lot are talking about it and are looking at it and experimenting with it, but they don't really have the expertise, the resources, or the access to big data themselves to really start to exploit it at scale. And frankly, also, why would they bother when they don't need to? If we're not patching, if we're not using strong passwords, if we're not using multi-factor authentication, why would they want to go to the time and effort of doing something a bit more clever and costly to them when they can just, pray and spray, or spray and pray, as it were, a load of automated, very basic attacks? We're still not getting the basics right. If we start to focus on world-class basics, rather than worry about the really kind of Gucci high-end hostile state or really high-end organised criminal groups, if they're going to come for you, they'll probably get you, unless you're an extremely capable organisation. Almost don't worry about that. Just focus on patching. That's still probably 50% of all successful attacks come through out-of-date software. Another 40% come through weak password, weak identity management, lack of multi-factor authentication. The number of organisations that still say, we don't want to make it more difficult for our staff to log on or do whatever. Well, frankly, you're just leaving your front door wide open, because the number of compromised... why would you go to the time and effort of hacking into an organisation if you can go and get a load of real-world credentials, a real username, a real password that's appeared in multiple data breaches around the world over the last 10 years and not been changed? It's really, really basic stuff. So there's a real kind of, I think, an optimistic message of just be really ruthlessly focused on the boring stuff, on the world-class basics. Make sure your senior leadership, or you if you're a senior leader, understand that it's the boring stuff that will get you the results. The basic principle of crime prevention is not to build Fort Knox. Nobody wants to live in a bank or a castle, or probably not many people, because it's not very accessible or comfortable. You just want to live in a home that's slightly more secure than your neighbours, so your neighbours get burgled and you don't. This is no different. This is no different. You just want to raise those barriers that it's not worth the effort, that they just move on somewhere else. So patching, strong passwords, multi-factor authentication, antivirus, all that kind of basic good stuff solves 90% of your problems. So a lot of this is quite easily managed. And if you're a small and medium-sized organisation or you don't have the in-house skills or expertise, come and join your regional cyber resilience centre. It's free. If you want to access some of the student services that can help test your systems to really understand where you need to improve, to maybe challenge your managed service provider with the evidence of where they need to improve, then we can help you with that. We've got the police cyber alarm as well, which is a bit of software that you can download and will actively seek out your vulnerabilities and also identify suspicious activity that we can then go and use that data to proactively target in an intelligence-led way rather than rely on people reporting as crime, which is a very old-fashioned way of doing police business. So there's loads we're doing. Operational Fangtooth, I think Phil referred to, that was an NCA operation taking over, infiltrating the Lockbit ransomware site. Completely compromised all of it and a lot of that network. There's going to be loads of operational activity off the back of that over the next few years. That's 25% of all ransomware. So that international collaboration and cooperation with law enforcement is really starting to have an impact. We need to do more of it, but in the meantime, focus on the basics, world-class basics, and you'll be in a good place.
Good. Thank you, Andrew. So the bad actors might be getting more sophisticated, but they'll still always try and find the easiest route.
Absolutely.
So Nina, I'm not sure whether this was a good idea to put you right next to Andrew, because my next question is, what's your view on how law enforcement agencies are dealing with all of the changes that are coming their way? And from where you sit, which is about the other side, what's your view on the role that law enforcement agencies play? And I'm hoping you're going to say something really positive.
If not, we can swap.
Yeah, we'll swap.
Yeah, no, I think there is a lot of positive change actually, but what we are. When we talk about organizations generally, all of them obviously want to lessen the disruptions to their businesses, but at the end of the day, they want to onboard more customers, more good customers faster. And so I think law enforcement agencies also do understand that, and we have seen, we're here to talk about AI and cybersecurity, but we are really seeing a true push with the regulators that is driving toward regulation in AI globally, but also in the UK. There was a bill that was tabled in the House of Lords not that long ago. There are debates around it. Hopefully it will be accepted, but certainly regulating will help the organizations, but I think it's very interesting balance to strike between what that regulation will allow us to do and how will it help us actually protect ourselves or not, because obviously the criminals might not be doing that today, but they're going to do it at a certain point. And with that, I want to stress, as much as the criminals have a lack of skills and kind of shortage of understanding of AI, there is still, unfortunately, a little bit of a lack of skill with the enforcement agencies in this space. You can see the trends of recruitment and roles appearing that are kind of looking for SMEs in AI, but the unfortunate truth is that the big tech companies are still the ones that are getting the best talents in this field, given the resources that are available to them, given the funds that are available to them. And so I think for enforcement agencies, it will be really critical to get some of those crucial SMEs from the industry to help them kind of guide future policies and to be able to capture some of those malicious activities and criminals that are entering in this space.
Yeah, makes total sense. And I think we haven't got time now, but I think there are quite a few examples of that happening in the UK, and the more that happens, the better. So a couple of last questions. Thanks, Nina. Phil, blockchain, you spoke about it before. What role does it play in hopefully improving the cybersecurity landscape?
For me, it's a question of data and data exploitation. Now, as I said before, by leveraging blockchain data and enriching it, it can really inform how law enforcement and the wider public sector really uses very much finite resources. So where can we target those resources to have the biggest impact? Whether that's fraud, whether that's ransomware, whether that's different hacking incidents. And we need to find a better way to exploit that data. And just, I think, on to Nina's point before, and I think she referenced DCPCU and various other agencies, I think there's a model there somewhere around public-private partnerships and data and intelligence exploitation. And for me, I think to get the most out of blockchain intelligence, we need to find a way to work better across the ecosystem to really exploit that intel, to disrupt offenders, to seize assets, secure and preserve evidence, prosecute. But there's also the crime prevention piece as well. So how can we use our data to sort of better inform and prevent victimization across a range of different crime types?
Thank you. And Barry, we'll finish on standards. You mentioned the importance of standards when it comes to having the right cyber resilience. How does the UK compare to the rest of the world?
I would say pretty favorably. The UK was pioneering in applying global open standards for open banking sort of 2017, 2018. And that is now enabling 320 organizations across the country to unlock new value and serve consumers and businesses better. It has stood the test of time. It's just had its 6th anniversary. That standard has evolved and is continuing to evolve. So FAPI, I'm going to talk about the standard and the open. So the standard is by name the Financial API Standard, or Financial Dash Grade, developed with the OpenID Foundation. It took 7 years to get to version 1, so it took quite some time with industry. But because we've applied the best minds in industry to create something that's so robust, you can have the confidence to build on that standard. And the UK is well positioned to be interoperable and compatible with other global markets who are building on those same standards, where secure by design, secure by default, it's built in from the get-go. And you can think about not worry about how, but worry about what you want to do, right? The actual innovative value, because somebody else has thought about the security and trust, and that's been built in from the beginning, as opposed to retrofitted at the end. So I think the UK is very well positioned.
Good, that makes sense. So we've come to the end of the panel. I would like to ask each of you, this is a quick fire round, 5 to 10 seconds max, please. We've spoken about AI in different guises in some of your answers. AI, good or bad for cybersecurity? Kate?
Necessary, because we have AI and we need AI to police AI.
Good if done properly.
Good predictive prevention is the way to go.
Good, but with the caveat that it depends specifically what crime type you're looking at. There's a lot of risk around the transformation of different fraud types being essentially volume crime, and these different crime groups, better utilising this technology to enhance their business models, which makes me quite nervous.
I think good. I think the potential and opportunity for AI-based approaches is going to be very interesting, but it needs to come with baking in cyber resilience from the start. So that investment to avail of emerging technologies needs to ensure the right investment to support the guardrails and the controls around that.
It's not often that you get a panel where everybody A, agrees, and B, when it comes to AI, ends with a positive message, which I think is really, really encouraging. So we've had sunshine, we've had rain, sunshine again. That's basically a day in cybersecurity. Thank you so much to my wonderful panel. Really, really grateful for all of your views and for being here today. Thanks all for being here and sharing this last half an hour with us. Enjoy the rest of the evening. Thank you so much.
Thank you so much, Danny. Fabulous moderation. You're very welcome. Thank you to such a brilliant panel. So enjoyable and also so informative with so many practical tips on cyber hygiene. Thank you. Well, can you believe that brings us to the end of day 1 of IFGS 2024? Just this morning, we had that video address from Rishi Sunak. We heard from the Economic Secretary to the Treasury. We had those great words from Janine. It was something like, be a dreamer and a doer. So many amazing speakers we've heard from all day. And that is not all, because tomorrow we'll be back here, and hopefully you will be too. We have more incredible insights from speakers on this old library stage. We'll be hearing from the former Chancellor, Lord Philip Hammond, alongside Labour peer and former General Secretary, Lord Ian McNicol. We'll also be hearing from the Shadow Economic Secretary to the Treasury, Tulip Siddiq, the General Partner of A16Z, Sriram Krishnan, Adrian Harris from the New York Department of Financial Services, the Chair of Open Banking Limited, Marion King, and many, many more leaders of organizations who will be at the forefront of FinTech's next decade, including Alika Bank, Atom Bank, Alipay, Klarna, and so many more. And don't forget, it's also the return of Pitch 360, where 10 of the most innovative FinTech startups are going to battle it out for our judges. You don't want to miss that. That's happening at 3:15 tomorrow. Thank you so much again to our gold sponsors, ClearPay, Square, the Department for Business and Trade, and Barclays Rise, as well as to all of our silver and bronze sponsors, our media partners, and to our charity partner, the Money Charity. But for now, thank you to all of you for joining us today. Please join us for drinks. They're taking place in the Great Hall. Thank you, and we'll see you tomorrow, hopefully. Take care.